Okay, hello everybody. Welcome to Korean Atlanta Mentorship. It is financially free Fridays where it's just an excuse to do velocity banking, kind of like eating tacos on Tuesday, right? Taco Tuesday. Now, before we get started, I'm just going to do a quick plug for a live stream we're going to have tomorrow. It's called Credit 101, only for YouTube channel members only, 99 cents a month. And we're just going to hang out and talk a little bit about credit, just for maybe about 30 minutes to an hour, hang out, live stream. And yeah, that's it. So let's get started. So we'll just do another velocity banking review. So, what is velocity banking? All it is a debt payoff strategy where you're using all of your money into debt or paying all of your money into debt with the help of a line of credit. So, in today's example, we're going to assume that we have maybe like a couple where one is a lawyer and the other is a doctor, right? Law school, med school. And we have $350,000 of income, gross income a month. And then after tax will be 21 grand. And we're going to go ahead and get started, right? So in order to do velocity banking, there's only two things that you need. Number one's a budget. Okay. So we have our budget right here. Two credit cards at $150,000, two student loans, one for law school, one for med school, two auto loans. So, if we're a doctor and a lawyer, we got to have those nice cars that are above $50,000. And then a mortgage for $600,000. And then all of our non debt expenses are food, gas, insurance, right? $3,500 a month. And so our plan is to get rid of all of this debt and stabilize this number, okay? So we have our budget. Now we need a line of credit as our main operating account. So what's a line of credit? Oh, it's a financial tool where you can borrow money, pay it back, and then use it over and over again, right? That's what a line of credit is. And so credit cards, line of credit, home equity line of credit, personal lines of credit, business lines of credit. I got lots and lots of lines of credit. So I have this home equity line of credit here for $280,000 limit, and then another one here, a personal line of credit for $15,000 limit. Now, the reason why people talk about home equity lines of credit in velocity banking is because whenever you put collateral or give a lender collateral like your home equity, they'll give you higher limits and lower rates, right? So this one here is 15%. My home equity line of credit is at around 8%. Okay. Well, it actually is 8%, not around. And I don't think it's variable. I think the last one I used was 10% variable, but this one here that I'm using is not variable, or at least I don't think it is. Now, here's the other thing about lines of credit too. Um, you got to get it way before you ever need it, right? So think of it like car insurance. So if you crash a car and you drive without insurance and then you try to get insurance afterwards after you crashed it, you're not going to get it. Or maybe there might be somebody who offers it to you, but I'm just saying in general, you won't get it. Same thing with the bank and a line of credit, right? So if you're financially strapped and you don't have that much cash flow, and you're like, you see this, and you're like, oh my goodness, I could really use a line of credit, folks. Banks for the most part are not going to give it to you because they don't like to lend money to people who need it. I know, sounds crazy, right? If banks aren't restaurants where the restaurant says, hey, if you're hungry, come here for food, the bank will laugh at you if you come to the bank and say, "Hey, I need money." Right? So, all right, let me go ahead and do this. And so we have our budget. We'll just assume that because maybe we have a home with a lot of equity, we have a $200,000 home equity line of credit. Okay. Now, what we're going to do is we're going to just to have the copy the same income and expenses. But the main thing that we have to remember is that we're not going to have any savings. No savings at all because the strategy is dumping all of your money into a line of credit. But we're going to have something called cash flow. And cash flow can be increased by moving what we call inefficient debt to the line of credit. So another way of thinking about it is high interest rate credit cards and short-term loans, usually very short-term, like one and a half years, they can be moved to a line of credit, and we're going to increase our cash flow. Now, the unrealistic thing about this is no one's going to give you a $200,000 line of credit if you need the money, unless you're part of the very lucky few. Okay, so but we're going to think like, well, what would happen if we had this huge line of credit? Well, the possibilities are endless if you know how to manage your cash flow wisely. Okay, so let's go ahead and move these two credit cards. That's $150,000 of debt. So that's 150,000, right? We haven't gotten rid of the debt. It's just like a balance transfer. And then guess what happens to these two credit card payments? $150,000. Whoa, take a look at that. We went from 3,400 to 8,400 in a swoop. How that happened, right? And then what we do is we put our entire paycheck, this 21 grand, into the line of credit, and then we take our expenses out, and then after every single month, it's going to go down by $8,400 every single month. Okay, so now let's go ahead and do this. We'll say this is month 0, and then we're just going to calculate month 1. And to calculate the next month's balance, it's the previous month's balance plus the previous month's interest minus, right, our whatever our cash flow is. So A471.53, okay? And then to get the interest is based on the average daily balance. Average daily balance. Got to remember that term, okay? And so to estimate the average daily balance, we use this average function right here in Excel, right? Get these two numbers, multiply it by the interest rate, which is 0.085 in this case. Mine is actually 8. I've had 10 before, but it wasn't too big of a worry. In fact, I had screenshots where it's like I use $100,000 in my line of credit at 10%, and I only pay like 0.1% in the total interest for that year. So let's go ahead and do that. And now let's go ahead and copy and paste these formulas, and then we'll just see how long does it take to pay off this line of credit. Holy wow, that was easy. So it's about 19 months to pay off this home equity line of credit, or the credit cards when it's transferred to the home equity line of credit. Okay, so 19 months, 150K. In certain places, that's the cost of a house, right? So now that we paid off our credit cards, let's tackle on the other debt. So we got the student loan, the auto loans, and the mortgage. Again, so here's the cool thing. We got this loan calculator right here. You could actually download it if you click the link in like the front homepage video or go to the about section of the YouTube channel. So here's the thing, okay? You just got to type in the current month with this calculator. So let me just go in here, and what's the current month? It's 19 months, right? And then I just type in 19, 19, 19, 19, 19, and it's going to tell you the current balance. Whoopsie, this should be 19. Okay, the current balance and what we call the current cash flow index. So the current cash flow index is like a ranking system. So go ahead and search on any search engine, Google, ChatGPT, cash flow index, and I'm just going to give you like the 5-second explanation. It's like a ranking system to pay off debt, right? The lower the number, the better. Okay, so these are lower than 50, so let's go ahead and pay these off. And let's go ahead and do that. So G3, and that's going to be about 78 grand of debt. So those are the two auto loans. Okay, so let's move the 78 grand of debt into that line of credit, and I'm just going to go in here, right? And let's do this. Whoopsie, I screwed up. I'll copy and paste this and do that here. Okay. And what we're going to, oh, whoopsie, I screwed up. So this is where I'm going to move that 78 grand, 78084.02. Okay. And then what's our new cash flow after moving that 78 grand? Well, the payment for the auto loans go away. So these two, this is 0, 0. And now look at this. Our cash flow is 10 grand. Holy, I don't even know what word to say. I'm going to cuss. But I try to keep it rated G like Will Smith before he used to slap people. Anyways, so let's go ahead, and we got this 10 grand of cash flow, and let's go ahead and now um, go to here to update it. So this is going to be minus 10591.664. That's our new cash flow. Yeah. And then now all we gotta do is copy and paste. And then we see here, okay, in month 27, we paid off those two auto loans. Whoa, that was quick. So that's about 8-month term that we paid off those auto loans. So let's go ahead and do that. So 27 months, right? So 27 months. So that's 150 plus 55 plus 54. That's going to be 259K. 259K. All right, so 259K. Excellent. Now, okay, let's figure out what the current balance of the student loan and the mortgage is. So let's just do that here. So 27 months. So this is now go to 0, 0. Whoopsie, not this one. 27, 27, right? So take a look at this. These cash flow indexes. Normally, you don't want to pay it off if it's above 50, or completely pay it off if it's above 50. But the thing is, if the number is high, you could chop your what I call chop your loan into pieces, aka chunking. Just kind of move some of the debt into the line of credit and then pay it off over and over again. So that should give you probably the most efficient interest savings. But I'm going to be a little bit lazy today. I'm just going to move one loan at a time into the line of credit. But definitely do not do this with the mortgage, right? Because if I move $571,000 of the mortgage into a line of credit, I'll get $2,500 of cash flow. Whereas if I move this one, I get almost the same amount of cash flow. You see what I'm saying? So let's go ahead and move this one at a time. And I probably wouldn't even do this in real life, to be honest. I'd probably just use what I call that chunky monkey method. I don't even know what it's called. No, I'm just kidding. I do know what it's called. All right, so plus 124,178.1. 178.1. Okay. So we moved that debt into the line of credit, and then now this law school loan goes to zero, and now our cash flow is 12 grand. Okay. 12 grand. And so now I'm going to copy and paste this here, right? So our new cash flow, and then we just got to update this number 12290.4.86, right? So let's go ahead and copy and paste. And then we see that in about 10 months, almost a little bit more than 10 months, just I think 11 months, we have it all paid off. Okay. And now let's do the same thing. So now this is going to be 38 months, right? So this is now going to go to zero. This is going to be 38, 38. So that's the second. So this is the med school loan, the DOCTA, right? $250,000. $186,000. Let's move it into here. Okay. And now 186,332.05. Okay. So did I move it? Wait, did I move it right? Oh, I think I screwed up. Yeah, it's plus. My bad, not minus. All right. So now what's our new cash flow? Okay, let's move up here. So this is now zero. And did I screw up? Oh, I forgot to record the milestones, right? So 38 months is when I paid this one off. So let's go right here. So this is 38 months, and then it's 259 plus 150. So 409K. And now that this student loan is gone, what's our cash flow? 15 grand. Holy do. Okay, let's do 15 grand right here. All right, copy and paste, and then this is going to be 15070.38. All right, and then we're going to copy and paste right here, and then let's scroll down, and in 52 months, now we are completely grad student loan free. 52 months. Okay, so now 52 months, and so now that's 409 plus 250, 659K. That's more than $500,000 of debt, right? And so that's, I think, a little bit more than 4 years. And then now we tackle on the mortgage. Why do we tackle on the mortgage? Or the mortgage last? Because think about this. We have to pay $600,000 to only get $2,500 back, right? So I don't know about you, but would you give $600,000 to someone to give you $2,500 back? That's not enough bang for your buck. But here's the thing: if you spread that over time, then it's going to accrue, right? So if you let me go back here. So now we're at 50. What was it 50? What months? 52 months. Okay. So look at all the interest that we paid, and if we go it to the full term, which is 360, that's a lot of interest. $310,000. So it's important to pay it off. Okay. I would pay it off early. It's just you just got to pay it off last, and it's a 3% interest rate. But 3% doesn't mean 3% of this, right? It's 3% over 30 years. That's like 50% interest, right? So let's go ahead and do this and plug this in our velocity banking calculator. And what we're going to do is just chop up the loan into pieces, right? It's called chunking. Okay, we just put it into chunk calculator, whatever that means. And this wasn't developed by me. Okay, so I'm going to tell you where I originally learned all this velocity banking stuff from. I learned it from an educational company called Renatus. So if you don't know what Renatus is, it's I think they're the ones who actually came up with the term velocity banking, believe it or not. So they had a class, and I learned this class in about 2017. I was only making 20 grand a year, and I was like, I'm never going to apply this. And then in 2021, I bought my first home, paid it off last June, July. I don't remember. I just have a paid off mortgage in 3 years. You know what I'm saying? And so I knew the concepts about then, but I didn't start teaching it until like 2023 because I was just like, well, I'm sick and tired of seeing people and their whiteboards because, you want to be a little bit more mathematical. Because here's the thing, when the banks and the lenders and the mortgage companies update your statement, they don't use a whiteboard to do it. They use um, database software, MySQL, MSSQL, Google Bigtable, one of those you know what I mean? Like they have those basically it's like fancy Excel spreadsheets that they use to calculate, all of your stuff for your loan, right? They spend a lot of money on that database software. But here's one thing I know, they don't use a whiteboard to calculate your loan. You know what I mean? So it's important to do the math, whether it's in Excel or LibreOffice or Google Sheets. You just got to do it because that's how they do math. They don't do it with the whiteboard, right? You know what I mean? All right, so let me go ahead and put the current balance of the mortgage. All right, so 542,899.66. 542,899.66. And then I'm going to go ahead and put in the payment amount, which is 2529.62. And let me just blank this one out. So basically, this is what we're moving to that line of credit called the chunk amount. And then here's the thing, most people like get super obsessed with this. The only reason I talk about this is because on the internet, people talk about moving your low interest rate mortgage into a line of credit. And I'm going to tell you something. I personally would not do that. I'm not giving you financial advice, but I just would not do that. Now I'm going to show you why, right? I've never seen a use case for this 21,100 where it actually worked out in your favor. You know what I mean? And sometimes, you might pay a little bit more for convenience because that's just life, right? That's why we do DoorDash, Uber, and so it's not always about saving money. There's a convenience factor, but if you're gonna pay 5, 10 times more, I don't know what's going on. So let me tell you what I mean by that. So let's say I move, and hopefully I got the numbers right, the income and the expenses. Give me one moment to check. Income 2,100, expenses 3,500. Okay, so let's go ahead and now move this entire thing into a line of credit. So 542,899.66. Okay. So you might be thinking, wow, this is pretty good because, if I replace my mortgage, wow, it gets paid off in 3 years. And look at how much I saved. I actually only paid $72,000 of interest and I save $163,000. Okay, but what if we just did this in smaller amounts, smaller chunks? What? I pay it off even quicker, 2.8 years and 24K. Whoa, that's mind blowing. So why would you give away 50K, which is maybe another Mercedes for you as a doctor when you don't have to, right? Or a Tesla. I want a Tesla. Now here's the crazy thing. Okay, so let's say that you're like afraid of like high interest rate debt or credit cards, and we just do this with a 30% credit card, right? What? Only 32 grand? And again, obviously that's more than the 24 grand, but that's way less than the 72 grand. Like the 30% credit card beats the first lien 8.5% HELOC. So people are and look at the time frame, still 2.8 years. So people don't really like understand this, but what I'm saying is that the first lien HELOC, I don't know if I do it. You know what I mean? Like I don't get it. But the thing is that you make sure that you do the math either with someone else's calculator or you at least use Excel. You know what I'm saying? Don't use a whiteboard because you ain't gonna you're probably gonna screw up. And if you have 360 lines of mortgage payments that you got to calculate, you're probably gonna screw up somewhere unless you use a calculator or a computer. Okay. But my point is this, right? Wow, 2.8 years, $24,000, and I didn't even need a first lien home equity line of credit. I have a first lien home equity line of credit, but I paid it off, and then I paid off my mortgage, and then I got the home equity line of credit. Okay, so now let's go back to the other spreadsheet. So we're going to go in here. So now let me just do this. So this is going to be 52 divided by 12 plus 2.8 years. I can't even believe that. Is that real? Let me check that other spreadsheet again. Oh, yeah. Okay. So 7.13 years, we are debt free. And how much debt was that? So that's 659 plus 600. Holy, it's 1.259 million of debt gone in about 7 years, right? That was easy. Oh, yeah, that was pretty easy. And now look at this. If this is gone, okay, look at that. 15 grand of cash flow a month. And now we're at where I'm not 50 grand. Every time you have that velocity banking calculator open, it gets so slow. But 17 grand of cash flow a month. And now we are in rich people problem land, which is where we want to be. We don't want to be in poor people problems, meaning that we can't sleep at night just because we have such little savings and cash flow. We want to be in rich people problem land. And what's that? It means you have so much money that now you're anxious by having this money in savings because it's not growing and you know you're not beating inflation. That's why rich people are so much easier to raise money from because they understand, like they feel the anxiety every time they look at their bank account. Like I have $100 or $1 million in my bank account. I got to put it to work. They're not afraid to lose money when they're at that point. Now, obviously, you don't want to make stupid decisions. You want to make good calculated decisions, but that's a good problem to have that you have too much money in the bank account, right? All right. Well, that's it for today. So this is what it's like to kind of think about if you're a lawyer and a doctor and maybe you're a couple. Hey, you'd be debt free, 1.2 million debt free in about 7 years, right? All right. Well, that's it for today. Have a great day. It's almost like Taco Tuesday, but it's not necessarily Fiesta Friday. It's financially free Friday. Doing another review of Velocity Banking. All right. It's Korean Atlanta Mentorship. Have a great day, and we'll speak next time.